The Fed is losing control. The pressure is not easing. The Fed's emergency repo facility got tapped yet again, and the $3.3 trillion repo market remains stressed, with SOFR remaining 12 basis points above the Fed's upper bound now for 4 days in a row. So arguably, the Fed is losing control over the most important price of all, the price of money, the price of a dollar. QE might be the only answer. Of course, here we're looking at SOFR spreads, and they remain quite elevated, as we will see. But first, the standing repo facility, the SRF, the Fed's emergency liquidity backstop, got tapped yet again this morning for $9.2 billion. The vast majority of that, by the way, mortgage-backed securities, as it has been the past couple weeks. Now, why is this occurring? Well, the Fed has been engaged in quantitative tightening. Just as QE, or quantitative easing, is the Fed printing money, injecting that into the banking system by buying financial assets from the banks, QT is the exact opposite. We can see bank reserves, inverted on this chart, have declined from about 4.2 trillion all the way down to 2.9 trillion. Now, a large amount of that decline has happened just in the past couple months when the Treasury rebuilt their buffer in their checking account, which is known as the TGA. Now, why do they need such a large buffer, $900 billion? Well, every 5 days, about $650 billion of Treasury bills come for redemption. So remember, Treasury bills, a very, very short-term debt instrument. Think not a 20 or 30-year bond, but think a 1-month bond. That is what a Treasury bill is. Very, very short-term debt security, about $650 billion in redemptions every single week. And that's not even counting coupon redemptions, which are about $300 billion per month. So the TGA drawdown that had been expected by many market participants is likely not going to come, meaning liquidity is not going to meaningfully improve from the Treasury general account getting drawn down, and of course that money getting injected back into the banking system. Here we can see, of course, a very strong negative correlation between SOFR spreads and bank reserves. Negative correlation here. As bank reserves go down, this chart goes up, we can see SOFR spreads do widen. The moving average shows the trend is quite clear, which is tightening liquidity conditions. Now, here we're looking at the same chart, just zooming way in. And I wanted to show the kind of precipitous drop that this is going negative, right? We have been in an abundant liquidity regime where there was more money in the reverse repo, again, a storage tank for excess dollars, than was being used from the standing repo, which is a facility for scarce liquidity conditions. And so by taking a spread, you can get a general idea of what sort of regime you are in when it comes to liquidity. We have been in an abundant liquidity regime where this number has been above zero. However, recently we have started to go quite negative right now at about negative 22 billion, meaning 22 billion more is being tapped from the standing repo than exists in the reverse repo. This data, by the way, is from yesterday. Now, here we're looking at the overnight funding markets. Of course, the Fed uses many different static interest rates to try to control the price of money. They use the discount window and the standing repo. That is the ceiling. That is the Fed saying, no matter how scarce dollars get, we will always sell them to you at, right now, 4%. Reverse repo saying, no matter how overabundant dollars get, we will always buy them at 3.75. And by setting that corridor, they are trying to control the price of money. Well, SOFR is telling them that they are not being very effective at controlling the price of a dollar loan, a very, very short-term dollar loan. And this is because the liquidity conditions are too tight. Now, it doesn't necessarily mean that liquidity in general is scarce. It just means that liquidity that is willing and able to be lent out is scarce. That is when SOFR remains elevated 12 basis points above the Fed funds rate, as we have been seeing the past 2 days. So SOFR has not come in at all. We remain 4 consecutive days above the Fed's upper bound. And of course, not only that, but Fed funds, the unsecured overnight lending market, we can see that spread has been widening as well, indicating liquidity stress in the Fed funds market as well. Here, by the way, we can see 3.89 for Fed funds. Here is SOFR. We can see again 2 days in a row at 4.12. Now remember, this is above the Fed's upper bound of 4%. We have not really seen elevation this significant, except going back to the end of October. And the other thing that I wanted to point to, a lot of people will say, oh, well, this is just normal end of month pressure. Month end, you can see SOFR start to spike above the upper bound. However, to this instance, SOFR has remained above the upper bound for 4 consecutive days in a row. And I did ask AI what it thought, and we'll show that answer here in a second. Here is SOFR minus the reverse repo award rate. We're looking at the difference between SOFR, the actual cost of an overnight dollar loan, the actual interest rate, dependent on supply and demand for dollars in the repo market, the $3.3 trillion repo market. We're looking at SOFR relative to the Fed's lower bound, the difference between those two lines. That is what this chart is showing. And as you can see, SOFR spreads are completely blowing out, really only rivaled going back to the end of October when they reached about 46 basis points above the reverse repo. Right now, we're about 37 basis points above the reverse repo award rate. Now, here we're looking at the distribution. So I updated my chart, and as we can see, 25% of that $3.3 trillion, about $800 billion, has been getting financed above the upper bound for like a solid month now, with a couple days here and there of exception where the bars are white, indicating below the upper bound. But the vast majority of the time, the past month or so, 25% of that 3.3 trillion has been getting financed above the Fed's upper bound. Now, for those that say, oh, this is just end of month pressure, I asked AI, well, first I gave it all this data, all the charts, and then I asked it, evaluate whether or not this is just end of month sort of pressure. This is what it said. They say that with rates breaching the Federal Reserve's upper bound of 4%, that cannot be dismissed as merely end-of-month funding pressures, especially over the past 4 or 5 days, depending on which part of SOFR you look at. Typical end-of-month pressures stem from balance sheet window dressing by financial institutions where banks curtail repo lending. They pull back on the amount of cash they are willing to lend out to optimize their regulatory ratios like the SLR, supplementary leverage ratio, leading to temporary supply shortages and repo rate spikes. Remember, if you're a bank and you got $100 billion, but you're not willing to lend it out, you are hoarding that cash. Well, that reduces the supply of liquidity that is willing and able to be lent out. These are usually confined to the last 1 or 2 business days of the month, with quick normalization afterward, as seen in historical patterns where SOFR might rise 5 to 15 basis points briefly before reverting. In this case, however, the stress began building on November 25th, several days before the month end, and has shown no immediate signs of easing, suggesting deeper market dynamics at play beyond routine adjustments. So what is the answer to this? Well, the answer is an increase of bank reserves. So remember, going back to this chart over here, bank reserves are in green, inverted. Remember, QE is how they responded when we had the repo rate crisis, and that built reserves. As you can see, again, this chart is inverted. So as the green line is declining, bank reserves went from about 1.4 trillion down to about up to about 1.7 trillion. And then, of course, there were all the events of 2020 that led to a huge amount of money printing. Bank reserves ended up going to 3.3 trillion. So that is the answer. There's really no reason to necessarily panic. This is easily solved by the Fed. QT obviously ending yesterday, 12/1, and they are transitioning into kind of this mechanical bank reserve management sort of program. It's probably not going to be enough, or at least SOFR is telling you it's probably not going to be enough. What is the answer? Well, it's money printing. It's QE. It's bank reserve creation. Remember, the Fed just prints bank reserves out of thin air and then uses those bank reserves to buy assets from the banks, buy securities from the banks. So now the banking system gets a bunch of freshly printed dollars, and the Fed gets assets to go on its balance sheet. That is why the value of the balance sheet goes up. Those were purchased with freshly printed dollars. That injects liquidity that would fix this situation. But as the moving average shows you, this pressure has been building going all the way back to July or August when we first started to cover it. So anyways, hopefully that was helpful, and I'll catch you in the next one.